It's my pleasure to join you here and to say thank you to ETF Global. I'm Mark Makepeace. I'm the CEO of Wilshire Indices, but I'm probably better known for my previous life. Prior to this, I was the founder and chief executive of FTSE Russell. In fact, showing my age, I first set up FTSE in 1995. And believe it or not, it was a start-up with just 9 staff. And I remember looking around on the first day to this empty office. So we were full of ambition, but not a lot else. By the time I stepped down, beginning of 2019, we had something like $16 trillion following us. $16 trillion that we could identify. So huge, huge change, okay? Now, I did try retirement, and I failed at retirement. So I'm back. The industry is going through a period of huge change, and I really wanted to be part of that. And I was lucky enough that about 40 of my colleagues from FTSE also wanted to be part of that and came and joined me. So we set up Wilshire Indices using new technology, so no legacy issues, but really with an ambition to be a disruptor. And if you think about FTSE in its early days, although it grew first in Europe and Asia before coming to America, FTSE in its early days was a disruptor. MSCI and S&P were the sort of Goliaths of that day. They still exist as the Goliaths of that day. FTSE has joined them, but I think this next stage will see a huge amount of disruption. And that's why I sort of wanted to come back and get involved. Plan to speak for about 20 minutes today, and then hopefully have some questions. So please, as I speak, if you think about those questions, otherwise I get very embarrassed if I stand here with 10 minutes to go and have to quietly leave the stage. So if I can make that your challenge, that would be great. So let me get started. From the inception of FTSE in 1995 to my current role at Wilshire Indices, I've been privileged to witness firsthand the relentless innovation, unwavering collaboration and drive for knowledge that define our industry. I mean, you really have to accept that this industry has just grown enormously. Over the last 2 decades, I've also witnessed dramatic change in investor behaviour, with appetite largely driven by innovation in productization, access and growth provided by this industry. From fee reductions that revolutionised passive investing and the ETP landscape to the dawn of active ETFs and the unprecedented growth of global markets and new asset classes, this industry has been a beacon of change and opportunity across global finance. But as we face a new era defined largely by technological disruption, and I'll talk about that a little bit more, climate change transition, I know we have deniers and those who embrace it, but it is a major force of change, and geopolitical shifts, we must begin to think differently. Think differently about how to best capitalise on the opportunities and challenges that will present themselves. However, with a renewed focus on many of the original building blocks of the industry and an openness to new ways of collaborating, I believe we can ultimately develop and deliver differentiated products. And I think the key to the future is about differentiation and personalisation. And this is what we need, not just for the investors in the US, but investors globally. Let me say a few words about lower fees, because I believe lower fees have reshaped our industry, and actually I think reshaped them for the better. As I look back to 2012, when Vanguard switched its benchmarks from MSCI to FTSE and QUISP, it disrupted not just the ETF market, but asset management more widely. It led to huge inflows of funds to passive ETFs and other fund structures to the benefit particularly of the biggest passive fund managers who grew rapidly and now represent the largest fund managers in our industry. It also set out how much investors should pay for an investment and set in motion a race to reduce fees, which many believed helped transform the ETF industry into the $10 trillion market it is today. As investors increasingly gravitated to the growing list of low-cost ETF offerings, the fee race, which helped ignite the passive investment wave, was on. iShares quickly followed with the launch of its low-cost core ETFs. Active managers took notice. They may have been late to the party, but they took notice, they capitulated and lowered their fees and focused on differentiated investment strategies. And today, active ETFs are a fast-growing part of the ETF market. Now, if I look back to those days, I was the one who did the deal with Vanguard to adopt FTSE on a low-cost basis. And when we announced it, I remember BlackRock standing up and saying, MSCI is the gold standard and this is a victory for us. By the end of that day, their share price was down. MSCI lost 31% of their share price. The market spoke very clearly and fees came down. Right? It's very hard to go against the market. Most importantly, the main beneficiaries of these changes have been the millions of investors who today have greater choice and lower fees. But I think the game's now moved on. It's not about fees, it's about that differentiation, and that's being driven by technology and data. There is also one downside to the fee competition, and that is the concentration we have in our industry amongst the largest 3 or 4 ETF providers. But again, I think the next stage of development of this market will enable many others to compete head-on with those large players. Now, our industry has gone through a sort of history of change. I'd like to just say a few words about that, and then I'll move on to start talking about markets and indices themselves. So the focus on leveraging technology to broaden US equity access and market infrastructure has spurred innovation across the development of investment offerings, efficiency and delivery. Before 1974, which was when the Wilshire 5000 was launched, it was the first broad-based index for the US. US equities were essentially an institutional marketplace, inaccessible to all but the wealthiest individuals. However, as technology, innovation, and regulation converged, we saw a dramatic change in investor access and investment appetite. In the 70s, we saw the creation of IRAs, abolition of fixed brokerage commissions, and the first index fund. In the 80s, we saw 401ks developed and the start of the early days for index industry. We had the launch of the Russell 3000, and then outside the US, we had the launch of the FTSE 100, and really it started to take off. In the 90s, ushered in the rise of discount brokers, the first ETF. You think about it, the first ETF was just in the 90s, so it's not that long ago. And the first target date retirement plans. And in the noughties, we saw the boom in index funds and passive investing and the early days of robos. Followed closely behind was a focus on direct indexing, the ETF rule, demand for personalisation via retail trading access, and the elimination of commissions. So I don't think anyone can argue that we haven't seen a huge amount of change in our industry already. But actually, that change is going to pick up in pace. You know, technology is going to make that seem a slow pace. So as we go forward, we need to think about what's going to drive that change going forward. As I look forward to that sort of next 50 years or so for the ETF industry, I believe the focus will no longer be on low cost or even active versus passive. It will be squarely on investment outcomes and how to achieve those outcomes through the development and delivery of a modern and differentiated and customized product. Now, the technology will allow customization at scale. Technology will allow us to do things we've found very difficult to do in the investment world. Not because the theories weren't there, but the computing power, as well as new technological approaches, were not up to delivering that. So let me just say a few words about equity markets today, because they have shrunk, they are smaller, and they are more concentrated. Today's global markets look markedly different than they did almost 4 decades ago, but many of the core equity benchmarks look remarkably the same as they did when they were first introduced in the 70s and the 80s. Looking specifically at the US, the almost 30% shrinkage of US listed stocks, combined with over 60% returns over the last 25 years, a result of structural changes in the US economy and the US equity market. The combination of fewer listed stocks, significant increase in stock concentration, and a total return of some 600% for the FT Wilshire 5000 since 1998 has driven by new industries and themes that are not adequately explained by the older legacy indices and market definitions we have all become reliant on. Concepts like digital, are only just beginning to come into the older industry classification systems. You think about that. A simple example is a definition of large cap and small cap. Back in 1998, a small cap stock was defined as having a market cap range of between $800,000 to $615 million. This range is now at the bottom 250 million, and at the top of small cap is 4 billion. So if you're just under 4 billion, you're still a small cap stock in this US market. That's the bottom 10%. Okay. Back in 1998, a large cap stock was defined as having a market cap of between 615 million and 260 billion. Right, 260 billion. That's This range has now become 4 billion at the bottom end and 3 trillion at the top end, and still going higher. Right? And the US market is over 60% of global equities today. Right? The last market that sort of had that sort of influence was the Japanese market. It didn't last long. The top 10 stocks, mainly driven by what we've called now the Magnificent Seven technology stocks, now account for over 26% of the total market cap, compared to a concentration level of 20% at the peak of the dot-com bubble in 1999. Well, why does this matter? Well, the characteristics and performance of different segments of the market can be very different and are affected by these things. That concentration of that Magnificent Seven does affect some of the definitions that we've just got used to in the past of trying to explain performance. Right? And using the word technology is no longer good enough, because technology is in everything. You've got to really define, what different parts of that market are, and try and understand what's driving it from a risk point of view, from a performance point of view. So we're in a situation where the lack of proper definitions and accurate indices are now, in some ways, quite misleading. And they give us an environment in which we're making decisions really based on false assumptions. So let me talk about the need for new index designs. Look, and this has always been the case. This is nothing new. You know, we think back to the original indices, the Dow Jones average. In the UK, we had the FT30. Believe it or not, the FT30 is still being calculated. It's a price-weighted index of 30 stocks chosen by the editor of the FT. That used to be how you assessed the UK market. And it moved on. It went cap-weighted, border-based, free float, because of the dot-com bubble, because they were overweighting some of the technology stocks which had limited free float, which was part of that problem. And so it's just kept moving on, right? But we're now at a stage where it needs to move on again, because we have some indices which clearly no longer represent what they say on the wrapper. And I think that's important. Now, in 2021, we modernised the Wilshire 5000 for this reason. The FT came in and is now an investor in Wilshire indices. So our indices are all branded FT Wilshire. So the Wilshire 5000 is now called the FT Wilshire 5000 to take account of how markets have changed and how advances in technology allow us to improve the designs of some indices. So let me talk about some of these. Firstly, determining size. You know, large and small cap is important. The legacy US equity indices methodology that use a sort of rigid stock count approach, like the top 1,000 or 2,000, so we think of the Russell, have encountered difficulty calibrating to these changing market dynamics. Now, at FTSE Russell, when I acquired Russell and integrated it, we were aware that this was a problem then. And when I stepped down in 2019, we were talking with all the clients of Russell to try and get them to accept the challenges that were inevitably going to happen. And the problems have just got worse in the last 5 years. The largest 1,000 stocks in the US now account for 95% of the market. That's a fairly broad-based coverage. So the next 2,000 at most can only account for the bottom 5% of the market. Right? We all sort of think if you're a small cap manager, you're normally investing in the bottom 10% and you're normally in the top end of that part of the market. And there's a reason for that. If you're in that bottom 5%, over half the stocks are microcap stocks, which have higher levels of unprofitability, higher levels of bankruptcy, and the profile of risk and the performance is very different. So if you compare the Russell 2000 with a range of other small cap indices that exist, or you looked at the bottom 10% and their performance, you get a very, very different performance. And we've seen that. Main reason why funds have been leaving the Russell 2000 ETFs and switching to other small cap ETFs. But it doesn't stop there. Global equity indices suffer from opaque methodologies, and this is due to a patchwork of fixes over the years. At FTSE, I was the first to sort of challenge the way we were doing things, and we introduced, first of all, a definition of emerging markets. Back in those days, what was an emerging market? What was a developed market? The analysts at the index companies decided. And it was a whole range of reasons. And when I sat down and questioned them, it was questionable. So when we started putting in a rigid system, and then MSCI followed, and then after that, you started to have markets get promoted, because promoting countries until then was difficult. Right? And then in came bigger markets like China, in came China A share market. And because of access problems there, you've got different weighting systems and how you introduce that. You've got different stocks included in different markets for a whole range of reasons. How you look at large cap across markets, all of these things evolved over time. And all of them were decided at a particular point in time. And now, of course, some of those decisions have worked out, but the vast majority have not, because markets have changed so much. But most notably for me, there were two areas. One is industry classification systems, which really haven't evolved with the ongoing digital transformation over the last 2 decades, which has rapidly changed the dynamics of the global economy. And that is more evident in the US than anywhere else, but is also very evident and growing in Asia. The transformation has fueled the rise of new industry sectors and subsectors that are redefining the makeup of traditional industries and where companies should truly fit, all ultimately impacting index construction and asset allocation outcomes. And the other area which I think the index industry really has to move forward in a big way is in factor investing and understanding your factor exposure. And while factor investing has grown significantly over the last decade, we are now witnessing how many of the early factor index designs are wildly off target. These early factor index designs use factor signals that tend to pick up a tail of other characteristics, which has distorted their performance, particularly in recent years. Certain factors decay quicker than others and have a bigger impact over different cycles. And therefore, some of the multi-factor approaches that have been offered in the market really haven't delivered the exposures they were meant to. So there are design flaws in these indices that are important to put right. Now, greater availability of data combined with advanced machine learning, AI capabilities, but just computer power, allows us to apply long-established financial theory in a way we could not conceive before. And the outcome of this are more targeted, pure ways of thinking about factors, and to be able to understand what your factor exposures are and how it influences performance, because factors explain the vast majority of performance in markets. Bringing fast-changing markets back into focus requires investment tools and an index partner built for this new environment, one that can turn data into information and that can more accurately value assets and provide a more robust framework for understanding risks, evaluating performance returns across asset classes, both listed and private. Ultimately, changing market dynamics need modern indices that are adaptive and provide appropriate future-proofing. Let me say a few comments before I start to wrap up. Let me say a few comments on the distinction between active and passive investing, because it is increasingly becoming blurred. Again, if I look back, we had sort of market cap benchmarks, and we were all comfortable with that. They were a benchmark, they explained the asset class, we all understood that. Then we started having strategy benchmarks, and FTSE was one of the first to introduce them, fundamental indices and weighted indices and other indices that were trying to follow a strategy. Well, these days, anything that has a systematic approach is replicated in an index form, whether that's a strategy, a theme, that's available today. And what's starting to become available is then how do you rotate between, and why should you rotate between different themes, different strategies? How do you value these? And that's coming. And I'll talk about some of the things we're doing in that space, but it's coming. So it's almost anything you wanted in a systematic approach, which was systematic active approach, indexation and the index providers will provide going forward, and in scale, and hopefully cheaply. As technology continues to advance at an amazing quick pace, it will further blur the lines of active and passive investing and drive greater demands for personalised investments. And in order to meet the growing personalised needs of global investors, the industry will need to have a mix of tools, technology, capabilities, expertise, and data to deliver meaningful and differentiated products that meet the new and growing needs of investors. We will likely see a future where regional investment needs focusing on specific investment criteria grow in significant demand, pushing issuers and fund managers to rapidly customise, scale and deliver solutions. Now, before I sort of got up here, there were sort of, very bright students standing up, we were applauding. As we look at that generation, ideas like wallets and the way they think of technology and the way they think about stocks, very, very different to people with grey hair like me. Right? So the world is going to change, and as those people come into the investment world, it will change even faster. To no surprise, cost is still very top of mind, and lowering cost operations and data services can help reignite production and delivery. But I do think in terms of fees, I'm not expecting to see more sort of fee competition, but I am expecting to see more economies that come through using technology and data. I mean, the data costs of people in the industry are just enormous. But in the future, I think it's not just data. The technology will give you functionality and tools that will enable you to derive forms of data yourself. And I think that world will change dramatically. Mitigating climate risk in a portfolio will also evolve to incorporate climate adaptation risks and opportunities. As the physical impact of climate change increases in our daily lives, investors will begin to shift focus on the sectors and companies focused on building or solving climate adaptation infrastructure, solutions, and how to better understand the new risks and opportunities to their long-term portfolio goals. We can already now start to track the impact of different parts around climate change. We know low carbon, if you'd invested in low carbon, actually you would have lost money, okay? All right? There's reasons for that, but if you'd invested in clean energy, you'd be up on the market. So we can now start to isolate these things and start to show not just what you're exposed to, but how it's affecting your performance. New asset classes and operational efficiencies will require innovative approaches. ETP providers will have to experiment and explore tokenization as it presents itself as the next generation of investment wrappers. It's interesting seeing BlackRock, one of the Goliaths of the industry, already getting involved, not just in terms of Bitcoin and digital assets, but in tokenization. And I think all of us really should be working hard in those areas. It will give all of us an opportunity to be innovative and competitive. It really does present itself as the next generation of investment wrappers. ETFs will continue. But if you're probably going to, in the future, at some stage in the future, trade ETFs as tokens. They're still ETFs. Right? Bringing with it significant opportunities to expand access to private asset classes and investments. How the industry can help achieve success with these challenges and opportunities can be found largely through collaboration. I think it's only the very, very biggest can do it on their own. But there's an opportunity here for even the smallest to collaborate and use and work with people to be competitive. Now, it's always a dangerous thing to do, but I was challenged to sort of look ahead and look at the future and give my view on sort of some of the things that are coming. To me, if I look to the future, data and technology will drive investment practices and index creation in the future. Digital technologies will also challenge existing market structures and distribution channels. Digital assets trade 24/7. They don't stop, not even for public holidays. Even on New Year's Day and other holidays, they still trade around the world. Right? And what we think of as digital assets today will change dramatically because all forms of assets will get tokenized. And already there are so many of these coins and tokens. Just trying to understand that market is a challenge in its own. I mean, we've already introduced a classification system just so people can understand that market as it exists today. So let me explain some of that and name a few areas for you to think about. We are working with clients in all of these areas. So I've only named sort of 5, but first one to me, the industry classification systems will evolve. They'll evolve to also allow easy identification of investment themes. I mean, some of this is already happening. So industry classification systems are starting to be modernised, and we've introduced a modernised version. We've also taken it to a sort of 4th, if you like, level where we're building themes, with the idea being is that you'll be able to integrate themes that go across industries as well as industries themselves. And you'll be able to think and have easy access to analyse those markets. Already we were approached by the infrastructure trade body GLIO for us to use this to identify infrastructure stocks, which we did with their membership and introduced that. And that has proved very popular. Second one was unique data sources that have potential to create alpha, explain performance, or identify risks. We are working in this area with several banks and data providers. I've talked about pure factors, but there's valuation data, there's impact data here, which we are starting to bring out, where we've analysed and we can show where they have an impact in certain sectors of the market, where you get significant outperformance or better understanding of risk. And I think you'll see more of this. The third area was client-generated customised benchmarks. And I make the point that these are client-generated. Today, if you want a custom index, come and talk to the index provider. You know, if you're lucky, within a few weeks, you've got your index. If you're unlucky, it can take months and months. Okay? We've brought out a system where you customise yourself. It takes minutes, right? And that's the future, okay? So we've got clients today using a platform we've created with all the tools, and they can customise. It takes them minutes. From creating something new, creating something very complicated, does all of that. Fourth one was greater computing power, machine learning, and AI, and I lumped those together. I mean, we all talk about AI. I think the marketing people particularly, we all talk about these things. But I lump those together because computing power's increased to such a degree, it allows us to do things we couldn't do before, or took us too long. And these will be used to create indices that can outperform their underlying benchmark. Here we are an index provider, and we've developed this. So we are outperforming our own benchmarks using these technologies. And the last one is tokenization of physical and other illiquid assets, which I think is starting to hot up. So let me finish, and we're out of time. Because of these fundamental changes in future, the relationship between the supplier, intermediary, and end client will change and become far more collaborative. Today, the largest index providers are not always seen as your partner. You know, at best, they're the supplier. But increasingly, partnerships will be more highly valued, and the most successful index providers will have a collaborative partnership relationship with their clients. And I say this, and this will go across sharing data, technology, ideas. Together, we will create innovative and differentiated products and give you the tools so that your clients themselves can create, with your guidance, customised investment approaches. I look forward to working with you in this new future, and I hope there's one or two questions. Thank you very much.